In contrast to isolated margin, which is assigned to a single position and cannot be shared, cross-margin enables the sharing of margin balances across numerous positions. The margin need offsets for positions in opposing directions and across various product kinds are possible with a smart cross-margin. In this video, we will discuss about what are cross, smart cross, and isolated margins. Also about the advantages of each. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So, watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So, let's begin the video. What is margin trading? Margin trading is the practice of funding a deal with borrowed money. Leverage, margin, collateral, and liquidation are the crucial terms to comprehend in margin trading. Leverage. This refers to making a trade with borrowed money. As an illustration, if a trader wants to purchase $1,000 worth of Ethereum, ETH, at a leverage factor of 5x, multiple of 5, they will only need to put down $200, with the remaining $800 coming from the exchange or trading platform. To put it another way, the trader took out a loan to multiply their position by 5. The equity is the worth of the account balance based on the current market price less the borrowed amount, although different trading platforms may use varying terms to describe this. Margin. Initial margin and maintenance margin are the two different kinds of margin needs. The sum of money a trader must deposit as initial margin in order to initiate a position. As a result, the equity level changes concurrently with the market price of an asset. The trader will receive a margin call if the equity level falls below a certain threshold, also known as the maintenance margin. To get the equity value back up to the maintenance margin required level at that point, they must sell part or all of their investment and/or add more of their own money to the account. Collateral and liquidation. A trader's account's holdings are used as collateral for the loan. The exchange or trading platform may sell the assets in the trader's account, a process known as liquidation, and use the proceeds to settle the loan if the trader fails to meet a margin call. What is an isolated margin? An isolated margin is a margin that can only be used for one position and cannot be shared with other positions. The key benefit of isolated margin is that any margin shortfall or position liquidation won't have an impact on other positions in the portfolio. This might be appropriate for a highly leveraged, speculative position that a trader wants to closely monitor and exert more control over. What is a cross margin? A cross margin, as opposed to an isolated margin, enables the trader to share margin balances across various positions, allowing the excess margin, that is equity above the required margin, which typically occurs when there is a gain, from one position to be effectively used to cover the margin deficiency, that is equity below the required margin, which typically occurs when there is a loss, from another position. A cross margin's key advantage is that, in some circumstances, it may be able to avert margin calls and the forced liquidation of a losing position. Advantages of smart cross margins. Smart cross margin enables offsets for margin requirements for positions in opposing directions, such as long versus short, and across several product categories. Spot margin, that is trading on margin in the spot market, futures, and perpetual futures are a few examples of product kinds. Smart cross margin has the ability to minimize overall margin requirements and increase the trader's capital efficiency. Positions facing the opposite way. This is about long and short. In a long position, you have purchased the asset. A short position entails selling the asset for a loss. Because the long position profits, loses, when the asset price increases, decreases, and the short position profits, loses, when the price decreases, they are positions in opposing directions, up. Because the short position makes money when the long position loses money, the short position would have margin excess for any shortfall in the long position. Likewise, for any margin shortfall in the short position, there would be a margin excess in the long position because the long position benefits when the short position loses. The trader may benefit from lower overall margin requirements thanks to smart cross-margin, which takes into account these offsetting impacts across holdings that are in the opposite direction. Several product categories. There are chances for margin offsets across product types because the same underlying asset might be traded on margin with several product types. BTC, for instance, can be traded long or short, on leverage, on the spot market, in futures and perpetual futures markets, as well as in these other marketplaces, i.e., the underlying asset in the futures contract is BTC. A trader may benefit from decreased total margin requirements because to smart cross-margin, which takes into account these offsetting impacts across different product types. Enhanced capital effectiveness. The decreased margin requirements allowed for the possibility that traders may utilize their money for other purposes. Funds are theoretically more flexible and liquid since they are less restricted by margin requirements. Share your thoughts in the comment section below to let us know. See you in the next video. Until then, take care and stay fit in health and wealth.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.